Value investing pioneer Benjamin Graham once said that the stock market is a voting machine in the short run, but a weighing machine in the long run. Once a company goes public on the stock market and its shares start trading on an exchange, the share price is determined by supply and demand. But over the long term, share prices are determined by the economics of the business. It's impossible to predict exactly what a stock will do and when, but we can study how share price movement works. Let's unpack Graham's statement a little more and go over how stock prices work. It starts with the initial public offering, IPO. Companies work with investment bankers to set a primary market price when a company goes public. The price is set based on valuation and demand from institutional investors. After the initial offering, the stock starts to trade on secondary markets, that is, stock exchanges such as the New York Stock Exchange, NYSE, or the Nasdaq. This is where we get into the market being a voting machine. For highly traded stocks, there are buyers and sellers on each side constantly bidding and asking for new prices. Institutions trying to build huge positions and even brokerages working for individual investors will bid for stocks. If there are more buyers than sellers, the price will get bid up. If there are more sellers than buyers, the opposite will happen. That's why Graham called the market a voting machine. On a second Bayesian basis, the price of the stock reflects what current buyers are willing to pay and what current sellers are willing to take. This might sound familiar if you took economics in college. It's the same principle for any commodity. The price is determined by supply and demand. The law of supply and demand is an economic theory asserting that supply and demand will meet each other at a certain equilibrium price. Now let's get to the weighing machine part. Over the long term, stock prices are determined by the earnings power of the business. Remember, a stock is a share of an actual business. The better the business does, the better the stock will do. Graham's protege, billionaire investor Warren Buffett, says that a stock is worth the discounted value of the stream of cash flows it will earn over the life of the business. To get the valuation of the business, he will estimate the amount of earnings the business will make in the future and then discount the future years, because money now is worth more than money you could get later on. Often a stock will deviate from that valuation, however. If it trades for less than the value, it is considered undervalued. If it trades for more, it is considered overvalued. Eventually, the stock price reverts to the value as the market weighs the stock price based on the earning power of the business. Investors who look to take advantage of deviations by buying undervalued stocks and shorting overvalued stocks are called value investors.